Hello, traders. Here we are again with some more videos, some trading instructions here, and we might learn something out of this one. So I wanted to ask you to put in your parachute because this is going to be heavy. We're going to be discussing stock volatility and option implied volatility with the price proportional distribution for estimating the future price of the stock. This is very important, and you can project prices. We did a good one today with the S&P 500, and some of the guys made some good money, so everybody's happy. So with that, we're going to move to the first slide over here, and we're going to look at the equity price volatility. We say that with a proportional distribution, it's like a bell curve, a curving. Come over here. So what happened is that between the very least and the most and the extreme is 100%. And then there has been some measurement that mathematicians do and all that stuff where the mean of the curve, most everything, 68% happening here. So give or take a percentage of that. Some of them are 64%, some of them are 68%, and so on. So if we apply this rule without going in details of the math that is used into it, we can say that the price is $50, and then it got 34% to move in either direction out of the mean of the 68%, then the price can swing through a period of time between $40 and $60, right? And let's say that next week, for example, the price jump up from 50 to 70, so that's kind of less likely to happen. This is what we hear, or less like. This is the norm. The same way that going down the price to $20 is much likely, and going down to zero, not likely. Or going from 50 to 100 in a very short period of time, more likely will not happen. Now, let's not take the number, but the percentage, because you have, for example, Amazon can move $100 in a day, but it's not a $50 stock. And this is the key here, the percentage of the price of the stock at a given time. With that, we're going to move to some example where we can calculate all this. The probability of the outcome on a set of dice is exactly as the bell curve that we got here with the mean. So you can tell that this bell curve can be applied to many things. It can be applied to stocks, can be applied for gambling, it can be even applied for the weather. So you're going to have days or some winters that are less colder, and you're going to have some summers that are going to be extremely hotter than previous before. So this is at the extreme. It don't happen all the time. Normally, things are average. When we apply the same rule to a game of dice, we find out that number 7 can be made 6 ways, and that's the maximum. So that's the top of the curve right here. And then the 68% falls someplace in here. Like over here, they got 68.3. We don't want to get exaggerated. For a stock, we use about 64%. So 68% of the combination can happen here, and then the rest fall down on this side of it, on the percentage-wise. So we're going to have the same bell curve here, but this is to determine the price of the stock, where it be moving for a certain period of time, and then we can take the percentage and apply it to the stock. So here we are. This is Facebook. This is 2020 chart Facebook. The reason I say that is because we also used this before back in 2013 with Carnival Cruise Line on a seminar. So we still have the copyright, which was filed in 2013, but we have brought up the chart to 2020 on Facebook. So as you can see, Facebook has been tracking right about 260, right? And this is where we set our line. This is our zero line here. This is the mean. And we can say that Facebook can go 32% up or 32% down from this point, and this is how we get that 64%, okay? 95% include much higher, and include from 15% added to the other side, and then we go to the streams, you know, that more likely not to happen, less likely, you know, very seldom or very hard to happen that you're gonna go to zero. You know, anything can go to zero, it can go higher, but it's very unique to happen just in just a quick jump, get there. So when we draw the line across these means, across the chart, it's very unique that we can tell that the stock have moved from almost 220 and it get to 260. And then when it get to the other 32% of it, boop, it stopped there and then it start coming down. The price of the stock come down. Finally, we're here. And if you were to use a stock, you're going to be buying puts or call. So on this side, when the price is trending up like this, you will buy call. When the prices start going this way, this is you execute the put. But you can estimate how far down the price is going to go, right? We don't want to buy a put that is going to be at 220 or at 190 because more likely that's not going to happen. We don't want to buy a call that is going to be at 340, right? Especially you see this here or going up. It's very unlikely that the stock will go from 220 to 340 in a very short period of time. So this is how we can establish where we're going to do. So we did it today, yesterday, we put out a video Sunday night so people can have it ready for Monday morning to trade with the S&P 500. I predicted, or I wrote in there, based on this chart, that it probably will get to 345, and that's what happened today. So everybody was happy, but don't do it because I say it, you know, because then you blame me. If it doesn't happen, then you blame me. Say, oh, he told me, he mentioned this on the video. So you got to figure this out, see how much money you can afford and what you can do with it to determine your losses. We can also use this to determine losses. So if we know that the price had gone from 260 to 220 to $40 a share, so if we're going to get in here in the bandwagon, our risk that we're willing to risk will be $40 a share that the price could go down and we might lose that money. So let's look out over here. We're going to use the same chart, okay? I mean, the same idea, but we're going to use it with Microsoft now. Microsoft, as you can tell, the price is different. So we're going to apply the same rule, 64%, but the stock is not $300, but this is 230. And we'll see how this come out. We don't know here, you know, we know this part here, this flat, this trend over here, this little channel here, we know that that's going to be a percentage where we're going to lay a line on it. Now, we cannot predict what is the price is here. You know, we know, okay, here we are on July the 13th, and now what is on the future? Do we know where the price is going from this point? So when we apply the bell curve into it, then it makes it more easy and more predictable where things can happen. So let's move. We have prearranged this for you to see it because of the sake of time. We don't want to run videos for an hour, hour and a half, or something like that to get the picture and the idea across when we can do it in less time and we take the fluff out of it. We don't want to fill videos with a bunch of junk information just to make it long to see like we look like we're expert. I'm a trader, okay? I'm not a TV guy. I know selling advertisement, and we don't sell anything. So here we are. We apply the bell curve into it. And as you notice, the low here, it falls just around this line. And then we have over here that we stop right here on July 13th. So this is where the whole thing went into it. Now, let's look further down, see how this is going to come out. Okay, so we're still there. We're going to come up on this one here on this slide. And what we're going to do now, we're going to go to this slide here, just where we are with all the goodies on it. And we're going to draw some lines into it. So what we're going to do, we got it right here. We got the line. We're going to check how thick we want it. We're going to make it red so we can see it. And we're going to draw the line and look how exactly this thing comes to. Here we are. This thing stopped there. We already knew about this one, right? We were someplace around here when we did the other one. We already knew that this was the bottom of the channel that we were talking about, right? So the channel is someplace in here. And now we can draw the center line. We make it black, change it to black, and we can tell how well the price traveled through there. Interesting, right? So we got 16% on one place, 16% on another. So we knew right here on the 13 that we didn't know what the price was going to be. But if we had drawn this chart in here, we could tell, he said, well, it's right here. We're going to see what happened. Is it going to go up or down? We throw our line and see where it goes. So, well, guess what happened? It was trending up, and the price continued going up to reach the other 60%. So you can see, we have established already that normally a stock travel between the stock price, when we convert it into percentage, we can predict just about how far it's going to go. So when it crosses here, it rests a little bit, but you notice that resisted go down below the zero line, our meaning, and then it continues to get here. And now we're coming down here. We're making another little trend here similar to that. So eventually we're going to have to take this, grab it here, and we're going to have to take it for a quick deal. I'm going to show you what we're going to do. Eventually, as the price progress, we can take this and move it and get ready for the next step. We're going to put a zero line there and see where the stock going to go by, right? So I hope you understand this. Be careful that what I say, get ready for a parachute because it start getting heavy here. So we saw what happened before. Eventually, we had to move our bear curve on a place that we can set just what's going to happen next. So we don't know at this point if we were going to use Microsoft. Is it going to go up or down? But we know that when it start going up, we got about 32% to go up here and be very extreme that go over this, right? We wish to see it, but it's less likely, very little chance that those things will happen. So with that, we're going to put that there back where it was before, and we're going to move to the next chart. So here we are, Microsoft with nothing on it. We came across here on July the 13th. It's going in here, it's coming in here, and now we don't know if it's going to go up. Now, in a couple of days, Microsoft going to make some announcements. This is the 12th, but we're coming around for this week to the, this is October the 12th. So when we did this about 2 days of trading before, now we're here on Monday on the 12th. We don't know where it's going to go, but if you apply the same thing, then we can expect, hopefully, that start moving up again within few days or week. Then that's when we jump in and say, okay, we know that we can get here 16%, probably 16% of the trade of the price of the stock. Now, here we go with option, the implied volatility of the option. This is very interesting, and I'm going to show two different companies. Because if you trade options on those prices, you want to make sure that you're paying the right price for your option. Remember what I had mentioned before. Implied volatility is excessive because it creates better price for the brokers and stuff like that. So we want to make sure that we're paying the right amount of the option price, that we don't overpaying for what we're getting. So brokers and market makers have tendency to overprice the implied volatility. you want to take, for example, here, DraftKings. Well, DraftKings over here, this is for, that was taken on October the 2nd. This is when we took the snapshot at 1 o'clock in the afternoon. This is the last week. This is just about to be on Friday. This ain't going to expire here on the 9th. It's going to expire in a week. And when we say need that by Friday, this price can move 118% on either direction. Well, if we're going to move 118% on either direction, this is going to fall below zero. Well, stock cannot go below zero, right? They go broke. And so we know that it's very drastic to that. So when you buy this option, you're going to pay a little bit too much. And look at it. It says here 75 cents. This is how much they want. 75 cents when they have a week to go. And in other words, they don't expect it to go too far, right? We got problems here. So for every dollar that the stock go up, you're only going to get 58 cents, and you got a week to make the premium that you're going to pay for that. Yet when we look over here, that is a week away. That'll be October the 9th. What this the next trade going to be? That's the, so this is going to expire here, and then next week we're going to get this one. Look what happened. The volatility for the same stock at 63 is only 85%. It's still a little bit more because too much, because what we know that for stock should be about 64, 68%. Now let's look at Facebook here. Facebook is at 261, 4 times probably higher than the other price, but the volume and the implied volatility, when you look at it, hey, 56%. But look at this. Eh? So if I buy a call over here, right, at 260, which is very close to that, how much are you going to pay for? Well, they say here that we're going to pay $1.99, right? And the implied volatility is only 56%. This one that is at the money, they want 118%. So this is more within the range that we talk about it when we look at this part here. 58% fall in between what we got here, right? 58% is inside of this range here. So I would rather buy an option, a call or whatever on Facebook for that price than buy the other one for DraftKings for that simple reason. Here we got Microsoft at 213. So if we're going to buy a 212, we got a 34% implied volatility. And if we buy a put, we got right about implied volatility of 34%. So they're just about the same. And it's much less that we have in our bird curve chart part of it. So there's more likely that there's very little movement on this price. You know, the same thing here is October 16 now. And this is the 10-9. So this is for the following week when this is going to expire. And we can see that this implied volatility. So always be careful with the implied volatility because that determines, you know, if you're paying too much for the premium. When you execute your order, for those that had difficult or never had done options, I know some of you do it all the time. This is securing an order through Fidelity. So when you get into the option, that's my name there. This is one of the accounts. We're going to move and say, okay, we're going to buy a call. So when you click on that window, what you're going to do, call. You're going to write or buy a write. You're going to do a color, combo, roll, strata, all kind of techniques here. You're going to buy to open, or you're going to buy to close, or you're going to sell to open, or you're going to sell to close on a specific shares amount, and so on. Then it tells you how much the broker is willing to pay, right? If you're selling, they want to give you 675, and if you buy, right, they want 690. So that's about 20 something cents, 15, 20 cents different in there. Then you go for the execution of the trade, and you can leave it auto so it can fill, or you can pick what exchange you want that to be executed. You want American Stock Exchange, you want Chicago Board Exchange, or you want Philadelphia Exchange and San Francisco Exchange and stuff like that. I recommend never to do that, because if you do that, the order might not fill. So you put it on auto, it will fill whatever the exchange have it open. You can put limit order, to make sure that you don't pay more than what you want. And that's actually how it works out. So we noticed that the last time that trade, that's not what it is now. The last trade was $6.80, okay? And it's down to $2.85 at this time. So if you're selling, you're gonna get $6.75. If you're buying, you're gonna pay market price $6.90. And the volume is 286. So with that, I can tell you that this kind of explain how you execute on volatility, how you execute your buy and sell your stock or option on that stock. And when you use the bell curve percentage-wise, you can have an expectation of what the price going to be and how much you expect to make, especially if you put in the risk of the trade, that I had to put X amount of dollars. So that'd be the risk from the previous low before. So like I showed a while ago, that was $40 different. So then say, hey, $40 a share, if the price goes that far, this is how it's time to lose, or where I'm going to put my stop to prevent that from happening. And the reward is how high can it go? Is it match? Do you want to make 200% on it? You want to make 100% on it for the time investing that you're doing. So I hope that this gets you some idea how to trade. I hope that also benefit your knowledge, even if you never need it, but you have it in advance. I've been using this for many years, and it contributed to my success in trading. And I just share the information with you all on the hope that you become a better trader if you knew about it. And if here you have a quick test to see, so refreshing your mind or refreshing your knowledge already. If you don't, the good thing about the video is that you can always repeat the video until you grasp the idea. So with that in mind, I want to thank you all for your time and subscribing on Facebook and helping share the knowledge without you having to pay anything. But this is one of the things that very few people know about it. Some people have paid courses $2,000 and they don't even get this mathematical formula that we don't have to know. It's already have been done for us. So with that, I want to thank you all for your time. And one more time, we'll probably see you tomorrow morning again with our daily briefing. And today was a heck of a good day, 3 hours of trading. And I make about 100% on it, so I can complain, and the other guy can't complain either. So thank you very much, and have a good evening. Drink some coffee, have dinner, take your wife or your girlfriend for dinner on an open patio, please. Bye.